There's a strange truth about American investors that doesn't get talked about enough. The single biggest factor determining whether you retire comfortably is not how much you earned during your career. It's not which stocks you picked. It's not even how early you started investing. It's what you did during the 5 or 6 worst weeks of your entire investing life. Most Americans over 40 will live through somewhere between 3 and 5 major market crashes before they retire. 5 separate moments when the news becomes terrifying, when every screen is red, when friends start calling each other in panic, when every instinct in your body is screaming at you to do something, anything, just not sit there and watch. Let me show you the blueprint. Because the difference between Americans who retire with real wealth and Americans who don't is almost never about what they did in the good years. It's about what they didn't do in the bad ones. And the bad ones are coming. They're always coming. Let me tell you what actually happens in the brain of an investor during a market crash. Because once you understand this biologically, the rest of this video starts to make sense in a way no financial advice ever has before. When the market drops sharply, your brain doesn't process the loss as abstract numbers on a screen. It processes it as a physical threat. The part of your brain that evolved to keep you alive on the African savanna, the amygdala, the ancient fear center, fires in the exact same way whether a lion is chasing you or your 401k balance dropped 20% in a week. Your body doesn't distinguish. Cortisol floods your system. Your heart rate increases. Your thinking narrows. Your attention becomes laser focused on the threat and impervious to anything else. This is not a metaphor. This is measurable biology. Researchers have put investors in MRI machines while showing them falling portfolio charts, and the brain activity looks almost identical to someone watching a predator approach. Your rational mind, the one that read all the books about long-term investing, the one that understood compound interest and diversification and market history, that mind is physiologically suppressed during a crash. The fear centers take over, and the fear centers have one objective: stop the bleeding. Now, this is where the single biggest mistake in American investing gets made. Because stop the bleeding means one thing in the stock market: sell. Let me give you the real numbers on how costly this is. Studies from the last 30 years consistently show that the average American investor earns dramatically less than the market itself over long periods. The market might return 9% annually over 30 years. The average investor earns something closer to 4 or 5%. That gap, which might sound abstract, compounds into enormous differences. On $100,000 invested for 30 years, the difference between 9% and 5% returns is over $1 million. Literally over $1 million. Where does that missing money go? Nowhere. It just doesn't get earned. Because the average investor panics at the wrong moments, sells at the bottom, buys back in near the top, and accidentally engineers the exact opposite of what they would have done if they'd simply held on and done nothing. This is where most people get it wrong. They think investing is primarily a math problem. It's not. Math is the easy part. Over 30 years, the math is actually quite favorable. American markets have a long, well-documented history of going up over long periods, through every war, every recession, every crisis, every political upheaval. The math wants you to get rich. What sabotages most Americans isn't the math. It's the 5 or 6 moments during those 30 years when the math stops feeling safe. When it feels like the world is ending. When the headlines suggest this time is different. When friends and family are making moves you're not making. In those moments, most people fail the only test that actually matters. Let me give you a specific example. March 2020, the pandemic hits. In about 6 weeks, the American stock market drops 34%. 34. That's a loss on paper of roughly a third of a lifetime savings for anyone who was fully invested. The financial news is apocalyptic. Every commentator is discussing the possibility of a multi-year depression. Unemployment spikes to levels not seen in living memory. The entire economy shuts down. In those 6 weeks, millions of Americans sold. They locked in the loss. They moved to cash. They waited to see what happens next. And by August, just 5 months later, the market had fully recovered. By the end of that year, it was at all-time highs. The Americans who panicked and sold in March missed the recovery entirely. They locked in a 34% loss and watched from the sidelines as the market climbed back past where it started. The Americans who did nothing, who simply ignored their accounts for those 6 weeks and let the chaos pass, ended 2020 up 18%. The difference between those two groups wasn't intelligence, wasn't information, wasn't strategy. It was behavior during 6 terrifying weeks. You don't need more money, you need a better plan. And the plan, when it comes to market crashes, has less to do with what you invest in and more to do with how you protect yourself from your own instincts. Because your instincts in this specific domain are not your friend. They evolved to keep you alive. They did not evolve to help you accumulate wealth across multi-decade investment horizons. This is where the entire industry of investment advice quietly fails most Americans. Financial advisors can tell you what to buy. They can tell you how to diversify. They can calculate expected returns. What almost none of them do, because it's uncomfortable and unprofitable, is prepare you psychologically and structurally for the moments when your own brain will turn against you. Those moments are coming, multiple times, and preparing for them is the single most important work you can do in your 40s. Let me walk you through the 5 specific psychological traps that destroy wealth during crashes. Not in the abstract, specifically. Because naming them is the first step toward recognizing them when they happen to you. Trap 1 is called recency bias. It's the human tendency to believe that whatever is happening right now will keep happening indefinitely. In bull markets, recency bias tells you the market will always go up. In crashes, it tells you the market will keep falling. Neither is true. But in the middle of a crash, recency bias whispers in your ear, "This time is different. It's not going to recover. You need to act now before it gets worse." It's the same voice that convinced millions to sell in March of 2020, December of 2008, October of 1987. Every single one of those moments felt completely unprecedented to the people living through them. Every single one eventually recovered. But in the moment, recency bias makes the recovery feel impossible. Trap 2 is loss aversion. This one is wired so deeply into the human brain that researchers have measured it to astonishing precision. Losses feel roughly 2 to 2.5 times more painful than equivalent gains feel pleasant. Losing $10,000 hurts more than gaining $10,000 feels good. by a factor of 2. This asymmetry means that during a crash, you are experiencing pain that is biologically more intense than any comparable happiness you felt from gains. And when you're in intense pain, your judgment is impaired. You want the pain to stop. And the fastest way to stop the pain of watching your portfolio drop is to sell. You convert the paper pain into a real permanent loss, and then, counterintuitively, the pain goes away because the account stopped moving. You traded compound growth for emotional relief. Trap 3 is herd behavior. Humans are social animals. We evolved to survive by paying attention to what other humans were doing. When your neighbors run, you run, even if you don't know what they're running from. In modern financial markets, this instinct becomes catastrophic. When markets drop, news coverage intensifies. Social media amplifies panic. Friends talk about their losses at dinner. Coworkers share rumors in the break room. Every signal around you says other people are afraid, and your brain, very sensibly by ancient standards, concludes that if other people are afraid, you should be afraid too. This is why crashes accelerate. The selling isn't primarily driven by new information. It's driven by each seller triggering more sellers in a cascading chain of collective panic. Trap 4 is action bias. There's a specific psychological pull during crashes that tells you the opposite of what's actually helpful. It tells you that doing nothing feels irresponsible, that watching your portfolio drop without taking any action is a form of passivity you should be ashamed of. Real men don't just watch. Real providers take action. Real investors adjust their strategies, and so people adjust. They move money. They rotate to safer assets. They try to time the recovery. They tinker. Every one of these actions feels responsible. Most of them are destructive. The data on this is consistent and depressing. The more actively investors trade during crashes, the worse their long-term returns. The most successful investors during crashes are the ones who did nothing, who stayed on their couch, who didn't touch the accounts for weeks. That level of inaction feels emotionally like cowardice. It is actually the rarest form of courage. Trap 5 is the most dangerous of all. It's called the illusion of control. In good times, we congratulate ourselves on our portfolio returns as if we personally caused them. In crashes, we believe that by acting, by making smart moves, by getting out in time, by getting back in at the right moment, we can personally protect ourselves from the disaster. This illusion is incredibly powerful because it feels like responsibility. It feels like maturity. It feels like we're being adults. But market timing, even for professional investors with sophisticated models and entire teams of analysts, is essentially impossible. Less than 10% of active fund managers beat simple index funds over long periods, and almost none of them do it consistently. If Wall Street professionals with billions of dollars at their disposal can't time markets reliably, the odds that you, with a laptop and emotion, can do it during a 6-week panic are effectively zero. This is where most people get it wrong. They believe their rationality during a crash is a form of skill. It's not. It's the 5 traps above, working together, creating an illusion of smart action while quietly destroying wealth. You don't need more money, you need a better plan. And the plan for crashes has to be built before the crash happens. Because once you're in the middle of one, every instinct in your body is working against you. The strategy has to be pre-committed, pre-decided, locked in during calm times when you can think clearly, and then simply executed when the moment arrives. That's what comes next. The pre-committed strategy is the single most powerful tool you have against your own brain during a crash. Let me explain what I mean. The moment to decide how you'll behave during a market crash is not during a crash. By then, it's already too late. The fear centers have taken over. The rational part of your brain is compromised. Every decision you make in that state is colored by cortisol and panic. The idea that you'll see what happens and decide calmly is an illusion. You will not decide calmly. You will decide emotionally, and emotional decisions during crashes have destroyed more American retirements than any recession itself. The solution is something professional investors call an investment policy statement. But I want to strip the technical language away because the concept itself is simple. An investment policy statement is a short written document that you create during a calm period. Right now, for example, that specifies exactly how you will behave during various market conditions, including bad ones, especially bad ones. The document answers specific questions in advance. What is my target allocation across the 3 buckets? What do I do if the market drops 10%, 20%, 30%, 40%? What investments specifically will I buy more of when prices drop? What is my rebalancing trigger? When will I not sell regardless of what the news is saying? The power of this document is enormous because when the crash comes, and it will come, you don't have to make decisions in the middle of your own panic. You just have to follow the instructions you wrote when you were calm. You become, in essence, 2 people. The calm, rational version of you who wrote the plan, and the scared, emotional version of you who executes the plan during the crash. The second version doesn't have to think. They just have to obey the first version. I've watched this transform investors. People who, without a written plan, would have sold everything in March of 2020, just calmly held because their written plan told them to. They didn't feel brave. They didn't feel smart. They just felt like they were following instructions. And because they followed instructions, they ended up wealthy. Here's what should go in your written plan. Let me give you a simple framework. First section, your target allocation. The 3 buckets with percentages. 20% in bucket 1, 20% in bucket 2, 60% in bucket 3. That's it. Simple, specific. Second section, your crash response protocol. If the market drops 10%, I will do nothing. If it drops 20%, I will rebalance by moving money from bucket 1 into bucket 3. If it drops 30% or more, I will continue rebalancing and I will stop looking at my accounts more than once per week. Specific behaviors, specific triggers, not emotional responses, pre-planned actions. Third section, your media diet during crashes. I will not watch financial news more than 30 minutes per week. I will not check my portfolio more than once every 2 weeks. I will not make any investment decisions based on what I'm hearing in social media, at work, or at dinner parties. Because here's the reality. The information you consume during a crash is not neutral. It's designed to provoke emotional responses. Financial news exists to keep you watching. The more alarmed you feel, the more ratings the network gets. Your media consumption during a crash is itself a financial decision. Fourth section, your accountability partner. One person, a spouse, a sibling, a close friend, anyone you trust, who has a copy of your written plan and who you've agreed will remind you of its contents, if you start to deviate. This is more powerful than most people realize, because when you're in panic mode, the worst thing you can do is act alone. An accountability partner is a circuit breaker. They can say, "You told me back in 2023 that you would not sell if this happened. Remember?" That single sentence has saved more retirements than any financial advisor ever has. Fifth section, your affirmation of what you know. A simple paragraph that says, in your own words, what you already know to be true about markets. I know that American markets have always recovered from every crash in history. I know that selling during a crash locks in losses and prevents recovery. I know that the biggest gains come in the first few weeks after a bottom, when it still feels terrifying to buy. I know that most professional investors underperform simple index funds. I know that the right action during a crash is usually no action at all. You're writing these things to yourself, to the scared future version of you who will be reading this document at 3 a.m. during the worst week of the crash. If you fix this, everything changes. You don't need more money. You need a better plan. And the plan written during calm times becomes the single most valuable document in your financial life. Not because it tells you what to invest in, because it tells you who to be when it matters most. Now, let me tell you something that almost no financial channel talks about openly, because it matters more than any specific strategy I can give you. Crashes are not just survivable. They are, for investors who behave correctly, the most wealth-creating events of an entire lifetime. Let me say that again, because it contradicts everything you've been taught to feel about them. The biggest opportunities to build real wealth in American markets have historically occurred in the 12 months immediately following major crashes. Not in the good years, not when everything feels safe. In the terrifying months right after the bottom, consider the data from March of 2009, when the American market bottomed after the financial crisis, to March of 2010, 1 year later, the market returned roughly 68%. 68% in 12 months. Americans who had the presence of mind to buy during that year or simply hold their existing investments saw their wealth expand at a rate almost impossible to match in any normal decade. From March of 2020, at the pandemic bottom, to March of 2021, the market returned about 75%. 75% in 12 months. People who kept investing through that period or who bought more during the drop essentially got their retirement accelerated by 5 to 7 years in a single crash cycle. This pattern has repeated throughout American market history. Every major crash has been followed by an explosive recovery period. And in every case, the investors who benefited most were the ones who didn't sell during the drop, and especially the ones who had the courage to buy more while everyone else was panicking. This is where most people get it wrong. They think of crashes as disasters to survive. They should think of crashes as opportunities to embrace. The person you want to become in your 40s is the person who looks at a 30% market drop and thinks, finally, prices are on sale, time to buy more. Not because you're reckless, because you're patient and you understand the arithmetic of what has always happened after every drop in modern American history. But here's the brutal truth. This behavior is extraordinarily rare. Less than 5% of American investors actually buy significantly during crashes. Most sell, some hold, very few add. Why? Because buying during a crash feels emotionally like running toward a fire. Every instinct tells you to go the other direction. And the discipline required to override those instincts is not natural. It has to be built. The tool for building it is simple. It's called dollar cost averaging into crashes. It means that you have a pre-committed plan to automatically invest money on a regular schedule, regardless of market conditions. Every month, whether the market is up or down, you invest. Every paycheck, money moves automatically into bucket 3. When markets drop, your automatic investments buy more shares at lower prices. When markets are high, they buy fewer. Over time, without you having to think about it, you end up buying more when prices are low and less when prices are high. The exact opposite of what most investors accidentally do. This simple discipline, automatic investments running on autopilot through good times and bad, has produced more American millionaires over the last 40 years than any sophisticated strategy. It requires no intelligence, no market knowledge, no timing skill. It requires one decision, made once, and then maintained across decades regardless of what the news is saying. Let me give you one more concept that might change the way you think about crashes. It's called the permanent loss versus temporary loss distinction. A temporary loss is what happens on a computer screen. Your account balance drops, you see the red number, you feel the pain, but the loss exists only on paper until you sell. Until the moment you actually convert those shares into cash at the lower price, no loss has occurred. You still own the same number of shares you owned yesterday. Those shares represent the same fractional ownership in the same American companies. Those companies are still making products, generating revenue, and operating. The market's opinion of what those shares are worth has changed, but the underlying businesses haven't changed. They're the same businesses, temporarily priced lower. A permanent loss is different. A permanent loss happens when you sell, when you convert the temporary paper drop into an actual, realized, permanent reduction in your wealth. Once you sell at the bottom, that loss is locked in forever. Even if the market recovers the next day, you've missed the recovery because you no longer own the shares. If you fix this, everything changes. You don't need more money. You need a better plan. And the plan, once you internalize this distinction, becomes something closer to peace. You stop seeing portfolio drops as losses. You start seeing them as temporary distortions in market psychology that have always corrected themselves. You stop fearing crashes. You start expecting them, planning for them, and even quietly welcoming them, because you've come to understand what they actually are for a long-term investor. They're discounts. They're opportunities. They're the market briefly offering you ownership in the American economy at a reduced price. And the right response to a discount is not panic. It's patience, followed sometimes by modest enthusiasm. Now, I want to address something that almost no financial content creator talks about, honestly, because it sits at the heart of why so many Americans over 40, even ones who've read all the right books, still panic during crashes. The discipline we've been talking about in this video is not natural. It's not intuitive. And for most humans, it's not even achievable alone. Let me explain what I mean. You can read 100 books about long-term investing. You can watch 1,000 videos like this one. You can understand every psychological trap, memorize every statistic about market recovery, write the most beautifully detailed investment policy statement ever created. And when the crash actually comes, when the screens are red, when friends are calling in panic, when your spouse is nervous, when the headlines use words like unprecedented and historic, you can still fall apart. The plan on paper is not the same thing as the plan executed under pressure. This is the brutal truth about investor behavior that doesn't get said enough. Information is necessary but insufficient. Understanding is necessary but insufficient. Good intentions are necessary but insufficient. What actually keeps Americans on track during crashes is structure, external structure, automations and systems and other people who don't depend on your willpower to function. Let me give you specific examples of what this looks like. Structure 1. Automatic investing that you cannot easily stop. When investments happen automatically, by default, without requiring you to take action, the path of least resistance becomes staying invested. Stopping them requires effort. Effort is hard to summon during a crisis. The friction saves you from yourself. Americans who have their 401k contributions set to automatic, and their IRA contributions set to automatic, and their brokerage account contributions set to automatic. Those Americans keep investing through every crash without thinking about it, because the machinery runs without them. The crash doesn't automatically stop the machinery. They would have to actively stop it, and most of them don't, because active stopping is a specific decision they'd have to make, so they just leave it alone, and they buy cheap shares during the panic without ever consciously choosing to do so. Structure 2. A portfolio simple enough to ignore. One of the great insights of modern investing is that simpler portfolios tend to outperform complex ones for individual investors. Not because simplicity is inherently better, because simpler portfolios are easier to leave alone. An investor with 3 index funds is far more likely to hold through a crash than an investor with 40 individual stocks. Complexity invites tinkering. Simplicity invites patience. Most Americans would benefit enormously from radical simplification. A total U.S. stock market index fund, a total international stock market index fund, a total bond market index fund, maybe a fourth for real estate exposure. That's it. 4 funds, allocated according to your age and situation. For most Americans, that's genuinely enough. Structure 3. Distance from the data. One of the single most reliable predictors of investor returns is how often they look at their account balance. Investors who check daily earn dramatically less than investors who check monthly. Investors who check monthly earn less than investors who check quarterly. Why? Because every check is an opportunity for emotion. Every check is a chance for your brain to notice a short-term fluctuation and feel something about it. The less frequently you look, the less often you experience emotional triggers that might lead to destructive action. Some of the wealthiest long-term investors I've encountered look at their accounts twice a year, not out of laziness, out of strategy. They know that more frequent checking correlates with worse outcomes, and they deliberately build distance between themselves and their portfolios. Structure 4. Accountability relationships. I mentioned this briefly earlier, but it deserves more attention. The single most powerful intervention against panic selling is having another human being whom you trust and respect, who has your written plan and who you've agreed can reach out if you start to deviate. This is not weakness. This is wisdom. Nobody is immune to panic alone. The most famous investors in American history had accountability partners. Warren Buffett has Charlie Munger. John Bogle, who founded Vanguard, openly wrote about the importance of having someone remind you of your principles when emotion takes over. If legendary investors needed accountability partners, you do too. Structure 5. The right relationship to the news. You don't have to stop consuming financial news entirely, but you need to consume it the way a veteran consumes war news, with emotional distance, recognizing that the drama is largely performative and the long-term trajectory is what matters. A useful habit is to commit, in writing, to waiting 48 hours after any major market news event before taking any action. The first 48 hours of a market panic are when the worst decisions get made. Simply pausing for 2 days is often enough to outlast the worst of your emotional response. Your rational brain starts to return. Your perspective widens, and the action you might have taken in panic is rarely the action you actually take once the initial wave passes. If you fix this, everything changes. You don't need more money, you need a better plan. And the plan that actually survives contact with a crash is never just on paper. It's embedded in systems, automations, relationships, and habits that don't depend on your willpower in the worst moment. That embedded structure is what separates Americans who retire wealthy from Americans who retire wishing they'd stayed the course. Before I close this out, and trust me, the final piece of this matters enormously, I want to pause for a moment. If you've made it this far into the video with me, if you've sat through brain biology and psychological traps and structural defenses without clicking away, if you're still here and still willing to look honestly at the way your own mind might betray you during a crash, I want to invite you to subscribe to this channel and walk with us every single day. This is the kind of conversation we have here. Not just what to invest in, how to not destroy what you've already built. The psychological and structural work that actually separates people who retire wealthy from people who don't. That's the work we do here, and I'd be honored to have you walking with us. And I want to say something directly. Most financial content creators will never talk about what we just covered because it's not profitable to talk about. Nobody makes money telling you to hold index funds and do nothing during crashes. The incentive in the financial content industry is to generate excitement, action, transactions, subscriptions to premium newsletters, attendance at expensive seminars. All of those require you to keep doing things. The truth that the best thing most Americans can do during crashes is nothing is commercially inconvenient, which is exactly why you so rarely hear it said plainly. But you deserve to hear it said plainly. You've earned the right over decades of working and saving to receive advice that serves your actual interests, not the interests of whoever is selling you advice. Now let me give you the final piece, something I haven't yet said, but which might be the most important thing in this entire video. The crash is not your enemy. I want you to sit with that for a moment, because the emotional framing of this entire video, even with all its practical wisdom, has still positioned crashes as something to defend against, as threats, as storms to weather. And that framing, while partially correct, misses something essential. Every crash is a transfer of wealth. That's the fundamental economic reality of what's happening. Wealth doesn't disappear during a crash, it moves. It moves from people who panic and sell to people who stay calm and hold. and especially to people who have the discipline to buy more. The person on the other side of every panicked sell is a calm buyer getting ownership of American companies at a discount. Over long periods, the calm buyer wins, consistently, demonstrably, across every major crash in modern history. This means something profound about your 40s and 50s if you understand it. You are living through what will likely be the best accumulation years of your entire life. The crashes that are coming, the 3 to 5 that will happen between now and your retirement, are not obstacles to your wealth. They are the mechanism by which wealth gets built. Every crash you live through calmly, continuing to invest automatically, is a wealth transfer in your direction. The panickers sell their shares to you at discounts. Their lifetime of fear becomes your lifetime of compounding gains. When you internalize this, something shifts. You stop fearing market news. You stop checking your portfolio during drops. You start seeing headlines about stock market collapses almost with a kind of quiet detachment or even relief. Because you know what they actually mean. You know that somewhere, a scared investor is selling their shares, and your automatic investments are on the other side of that trade, buying those shares from them at a lower price than they cost yesterday. That is the psychology of the American investors who retire truly wealthy. They don't fear crashes. They quietly understand what crashes actually do. And they structure their lives so that crashes, when they come, work for them rather than against them. If you fix this, everything changes. You don't need more money. You need a better plan. And the plan at this level is no longer just about accounts and allocations. It's about identity. It's about deciding who you are going to be during the scary moments. The person who panics and sells, or the person who calmly watches, follows their written plan, keeps their automatic investments running, and perhaps quietly adds more during the worst weeks. Both of those people exist as possibilities inside you right now. Which one actually shows up during the next crash is determined by the work you do in the calm years before it arrives. That's what this video has really been about, not crashes. You, the version of you who will show up when it matters, the structures and commitments and habits that will determine more than any investment choice, whether you retire wealthy or whether you retire wondering what went wrong. Start now, before the next crash arrives, because the next crash is coming. And the version of you who's prepared for it is not the version who happens to be lucky. It's the version who did the work, quietly, in the years when the market was calm and nobody was paying attention. There's a scene I want you to carry with you after this video ends. Imagine yourself, maybe 10 years from now. You're in your mid-50s or late 50s or early 60s, and something has happened in the world. A pandemic, a war, a banking crisis, a political event. Something big enough that the American stock market has dropped 30% in 6 weeks. The news is loud. Your friends are nervous. Your spouse is anxious. Your adult children are calling to ask if you're okay. You're sitting at your kitchen table. Early morning, coffee in your hand. You open your laptop. You look at your portfolio for the first time in 2 weeks. The numbers are red. The losses are significant. And you notice something strange happening in your body. Nothing. Your heart isn't racing. Your thinking isn't narrow. You're not scanning for the sell button. You're just looking at numbers the way you might look at the weather forecast on a rainy day. You already know what this is. You've been through it twice before. You know what comes next. The market will recover, as it always has. And in the meantime, your automatic investments are running in the background, buying shares at prices you would have celebrated 6 months ago. You know that in a year or two, maybe 3 at most, the numbers on this screen will be higher than they've ever been. And, with a kind of quiet certainty you didn't have when you were younger, that the scariest moments are the ones that, in retrospect, always turn out to have been the most valuable. You close the laptop, you take a sip of coffee, you go for a walk. That person, the one sitting at that kitchen table in 10 years, calm and unshaken, is not a different person from the one watching this video right now. That person is a version of you that you build starting today through the specific work of preparing yourself before the crash arrives. Automatic investments set up, written plan created, accountability partner chosen, media diet curated, portfolio simplified, emotional habits practiced in the calm years, so that when the storm comes, you don't have to become someone new. You just have to execute the plan you built when you were clear-headed. This is the great unspoken truth about American investing. The wealth that actually survives across decades is not built by the people who were smartest, or luckiest, or earliest. It's built by the people who were most boring, the ones who set things up correctly and then stayed out of their own way. The ones who understood that their main job during the rare and scary moments when markets collapsed was to do nothing dramatic, to keep working, to keep contributing, to keep believing what history has demonstrated over and over again about the American economy's capacity to recover from anything. Your job between now and retirement is not primarily to pick the right investments. It's not to time the market. It's not to outsmart anyone. Your job is to build the kind of internal and external structure that lets you become boring in the moments when everyone else is being exciting, to be calm when everyone else is panicking, to be disciplined when everyone else is reactive. That boring, calm, disciplined version of you is the one who retires wealthy. Not because they worked harder than anyone else, because they refuse to participate in the behaviors that destroy wealth during crashes. Start building that version of yourself now. This week, set up the automatic investments, write the plan, name the accountability partner, radically simplify the portfolio if it needs it, commit to the media diet. Make these decisions now while your brain is calm, so they're already locked in before your brain needs them most. Now, before you go, let me ask you for 3 things. First, if anything in this video shifted something in you, subscribe to this channel. Walk with us. The conversations here only get more valuable as they build on each other. The next video in this series is going to be about the specific mistakes Americans over 40 make when trying to help their adult children financially, and why the well-intentioned help that looks like love often does damage that takes decades to undo. You don't want to miss that one. Second, share this video with 5 people. 5 friends, 5 co-workers, 5 family members, people in their 40s and 50s who are going to live through the next crash whether they're ready for it or not. You might be the reason, years from now, that one of them doesn't sell at the bottom. That one of them stays the course. That one of them retires with dignity instead of regret. And third, leave me a comment. An honest one. Tell me about a time you let emotion dictate an investment decision. Tell me what you learned from it. Tell me what you want me to dig into next. Every deep video we make starts with someone asking the right question. Take care of yourself. Take care of the people counting on you. And remember, the investor who retires wealthy is not the one with the best strategy. It's the one who refused to abandon their strategy during the worst week. The work of becoming that person is done now, not someday. Now.